Hello, I'm sure by now you've heard from multiple media news outlets and different reports about the one big beautiful bill that has now been passed officially by Congress. There is a ton of information in this bill, but I did want to record a video and cover what will impact individual taxpayers the most. I did release a blog on this as well that has been sent out, but I wanted to jump on here and add some additional color and some more information as to what is included in this bill. So let's get into it. The first and the biggest, most expensive part of this bill is that they have made the current tax brackets and tax rates permanent moving forward. This was a temporary extension passed in 2017 that has now been permanently extended by this bill. Of course, unless different regimes come in the future and pass their own bills to change these tax brackets. But for now, for the foreseeable future, these tax brackets are locked in. They will no longer expire as they were set to at the end of this year, and the rate structure remains the same. The income thresholds for each bracket are updated and indexed for inflation moving forward as well. We can take a look at the current tax brackets, what they are now. So this is how the rates are going to be, this is how they're going to look moving forward, as the same as they were in 2025, the same as they are today. They will be indexed for inflation and increase over time, but now these are made largely permanent, which is quite the benefit to individual taxpayers. As you can see in this slide, these are the changes that would have occurred in 2026 if the Tax Cuts and Jobs Act was allowed to sunset as originally planned. So you can see, especially in the higher earning incomes over here on the right, the net change is pretty substantial here, especially for the largest tax brackets. And then some of the, for example, the 24% tax bracket and the 32% tax bracket, which a large portion of wealthier Americans reside in these two tax brackets. So definitely welcome news for wealthier taxpayers. No, not a huge change for taxpayers in the lower brackets down here. But still going to save you some tax dollars as opposed to what would have happened if it would have sunset. Some additional provisions that were actually increased. The child tax credit was increased by $200, up from $2,000 previously, and now $1,700 of that is a refundable tax credit, so you can actually get that back in the form of a return if the rest of your taxes equal basically zero. So that is a big portion of this. The standard deduction was also increased from $15,000 to $15,750 if you're single, and married filing jointly up about $1,500 to $31,500 there. The estate tax and the gift tax exemption has also increased up from 13.99 million to 15 million. And married, you get double that. So that is welcome news, especially for wealthy Americans, and passing assets down to their children. So that is a big change there as well. The big one that has been pushed on social media and media outlets across the country is there's no tax on Social Security anymore. That's a big misconception. It's not actually that your Social Security benefits are not taxed anymore. Instead, it just offers an additional $6,000 deduction if you are 65 or older. There are phase outs that apply, so it is not across the board by any means. It depends on your income, starting at $75,000 for a single filer and $150,000 for joint filers. So if your taxable income, if your modified adjusted gross income is above those amounts, you will begin to reach that phase out territory where that deduction starts to become smaller and smaller. And then if your income is above $175,000 if you're single, or $250,000 if you're a joint filer, then that deduction is completely phased out. Another big thing to note is that this only applies from 2025 through 2028 and is scheduled to go away in 2028. So definitely help for adults over age 65, which can offset a bit of Social Security income and taxation on that Social Security income. However, it's not just a blanket Social Security is tax-free now. There are stipulations that you have to meet, and it's important to keep this in mind when withdrawing from different types of accounts. And it's very important to work with someone like me, like Sean, like our team, like Braden to figure out exactly what we need to do to make sure our withdrawals don't increase this level, so we can take advantage of that Social Security, that tax deduction that is included in this bill. Next, we'll talk about SALT cap deduction. So SALT cap is state and local taxes. That's what SALT stands for. Previously, under the Tax Cuts and Jobs Act, there was a limit on how much you could deduct. This limit was $10,000, and this was an itemized deduction, which means it was in place of your standard deduction, and in combination with all of the other itemized deductions you may have, for example, charitable giving, then if it was over the standard deduction, you could take the itemized deduction. Now, what has happened is they've raised this cap from $10,000 to $40,000. It will also increase 1% annually through 2030, and then it will revert back to the $10,000 cap. This also does phase out at $500,000 of income, and like I said, only applies if you itemize your deductions. Now, what specifically counts as state and local taxes? You can either deduct the state income tax you pay or the sales tax and property taxes and motor vehicle license tax. So either one of, your income tax or the sales property tax you pay on your assets. This is a welcome change. A lot of politicians in high state tax states like California and New York were pushing for this, and it's a big benefit to higher earners who live in the higher state tax states. The next is no federal tax on tips. Now, again, this is very conditionally specific. It is a targeted relief for small but definitely essential part of the workforce. You can deduct up to $25,000 a year in qualified tips for workers customarily receiving tips before December 31st, 2024, which means you can't just structure your business now in a way that all of your income is tippable income if it wasn't if it wasn't structured like that before. So you can't just say, oh, I'm not going to take a salary. All my customers are going to pay me in tips now. The IRS is not going to let you do that. You do not need to itemize your deductions to claim this. So this will be an above the line deduction, they call it, before your standard deduction. The phase out does begin at $150,000 of income. And again, it does sunset in 2028. So one of those that's effective 2025, but does stop in 2028. So another thing to note is you must include your Social Security numbers on your tax return to take advantage of this deduction. Something interesting about this is that only 2.7% of the workforce actually earns tips, and most of those workers, almost 37% of those, earn below the federal tax threshold. Basically, their standard deduction is higher than the amount of income that they earn per year. So not going to really affect a whole lot of people, but it was one of the bigger notable items in the bill that deserves some attention. Another big part of this bill was no tax on overtime pay. So the deduction amount is $12,500 for single filers or $25,000 for joint filers. And again, there is a phase out that begins at $150,000 for single, $300,000 for joint. Another one of those that goes from 2025 to 2030. The interesting part about this portion of the bill was that it only covers FLSA required overtime pay. So it's very specific and it's federally regulated on what counts as overtime pay. It also doesn't apply to overtime that is required only by state law or by union agreements. So there's a lot of stipulations and a lot of specifics that must be met before you can use this deduction. It does not require an itemized deduction, which is nice. It's another above the line deduction, so you can still take this deduction and then take the standard deduction. An interesting fact about this is you cannot double dip, so you can't deduct tips and overtime income on the same income, right? If you work overtime and then you get tips on that overtime hours, that cannot be deducted. So cannot double dip there. Another interesting one is deduction on auto loan interest. So you can deduct up to $10,000 per year in the interest you pay from 2025 to 2028. So a real short window here. Very specific requirements as well with this one. To qualify, the vehicle must be assembled in the United States. It can be a car, van, SUV, truck, or a motorcycle, but it must be under 14,000 pounds. It can be for only personal use. So if you buy a truck and run it through your business, you cannot deduct the interest that you pay on that loan. It must be the first loan on the vehicle, so no refinancing your current loan to take advantage of this deduction, and the loan must be secured after December 31st, 2024. So if you have bought a new car between now and when this is passed, it will be, retroactive since December 31st, 2024. There are phase outs. 100,000 to 150,000 single, 200,000 to fully phased out at 250,000 joint. Something interesting to note, it does stack with the 7,500 electric vehicle credit, part of the Biden tax bill that was passed last regime. This bill is going to end that 7,500 EV tax credit beginning September 30th, I believe at the end of September. However, there is a small window here, right, where if you are looking at buying a car already, if you are in the market for a new car, you can go purchase an EV. You can get a $7,500 tax credit for purchasing that EV, and you can also get a loan on that car and then deduct the auto loan interest that you will pay. Now, that's only from now until about the end of September, but that is an interesting planning opportunity. If you are already in the market for a new car, I will stress that going out and buying a new car just simply because of this is probably not a good idea if it does not fit within your overall financial plan as a whole, but definitely an interesting planning opportunity there. Something to note, ATVs, trailers, campers, or salvage vehicles or vehicles you would buy just for the parts do not count towards this. So it's got to be a personal use vehicle. And it can't be ATVs or trailers or campers. The big one that's been floated around, Trump accounts for newborns. So this is basically an investment account for your child that you can deduct the contributions to, just like a traditional IRA. No withdrawals are allowed before age 18, and you can contribute up to $5,000 per child annually. They also are allowing for employers to set up a way to contribute $2,500, but that is, it has to stay below the $5,000 cap total, even when taking into consideration potentially $2,500 from your employer. So if your employer would contribute $2,500, then you could only contribute $2,500 to get to the $5,000. No contributions are allowed after age 17, and then they are dropping a kind of pilot bonus, right? So from 2025 to 2028, federal government will contribute $1,000 for every U.S. child born. Now, the specifics on this are a little fuzzy, and the implementation has not been kind of decided yet. What type of firms will sponsor this account? What type of tax forms are going to be needed to be filed in conjunction with this account? How will the United States contribute that $1,000? Is it just going to be a tax credit on your tax return each year? Those are all still things to be decided. There's a lot of people still digging through this bill and what it means for individual taxpayers. So as we learn more, we will continue to communicate that with you. But until then, those are some interesting and unique characteristics of this new bill that affect individual taxpayers the most. So if you have any questions or any specific concerns about this bill and want to know how it may affect you and your family, please let me know, and I will do my best to research that and get you an answer out there. Thank you for your time, and as we learn more, we will continue to put out content on this, so definitely stay tuned.